The manufacturing sector contracting for the sixth straight month in September, but there could be signs of hope ahead as new orders improved and prices paid for inputs declined to a 9-month low. Joining us now is Tim Fiore, chair of the Institute for Supply Management Manufacturing Business Survey Committee. Tim, it's good to see you. So bottom line, September ISM manufacturing, Tim, the index remained in contraction, 47.2. Did see some notable swings in components, but walk me through what you're seeing, Tim.
So we remained at the same rate of decline as we saw in August, which is a good thing because the 47.2 is not a major decline. It's a moderate to mild decline. It's in that borderline area. It's very consistent with where we've been for the last 12 months, actually almost 24 months, and it's pretty representative of a soft landing. So 47.2 this month, 47.2 last month. The biggest change this month, our PMI is made up of the sum of 5 sub-indexes divided by 5. So you look at new orders, you look at production, you look at supplier deliveries, you look at inventory, you look at employment. The big thing that changed this month for the positive is that our production number returned to a stable, generally 50, which means it's almost like a surrogate for revenue. So we're pretty much the same level of output in September as we were in August, which I think is a good thing. It's showing that the bottom is not falling out, which is really positive. I don't think anybody's expecting the top to grow that much at this point, but the bottom is not falling out. In addition to that, we have continual declines in employment, which is the activity our panel members are taking to right size their cost structure consistent with the latest forecast for growth going forward. So I think it's a good report. Your comment on demand, yes, we do see some signs. They're very weak signs. Demand is still non-existent. We've had basically 24 months of burning off the most significant probably had in manufacturing history. And we're now at the point where there's not that much left in the order book. We've got to get some new orders in to spur growth and investment and the re-entry into a growth profile.
And Tim, all of that looking backward a little bit, although you were just talking about looking forward, but there's a couple of unusual events that could have an effect on the next survey. There's the port strikes, and then there is the hurricane that just took out a lot of manufacturing as a result of cutting a pretty broad swath across the Southeast. So what should we expect in the next report?
Yeah, thanks, Julie. So that's a good lead in. There is a third too, and that's the Boeing strike. So, okay, that hurricane is going to cause problems in data quality in October. Not so much quality, but our ability to read what it means, especially with respect to going forward. That hurricane is going to disrupt a whole bunch of stuff. Most likely the transportation lanes are all going to get messed up. We have a lot of people out of work because factories are shut. They can't get to the work site. And we had the Gulf that was closed down days before that hurricane came through and is just now starting up with the impact on plastics, possibly natural gas prices and so on. So what I've said so far today is that October is going to be a really hard month to take its data, load it into the prior data, and forecast what is going to happen going forward. But I kind of know what this looks like. We saw it back in 2017 with the big hurricane in August of 17. So we'll deal with that. The second one here is the port strike. This port strike has to end in a week. If it ends in a week, then okay, we just move on. If it goes on beyond a week, it's going to be a problem. For instance, if it went on for a month, you're probably looking at 3 months worth of disruption that we're going to have to work through. And the sad thing is that it's going to mess up the transportation lanes again. So we won't know whether it's new demand activity that's causing the anxiety and the strain in the transportation chain, or whether it's because they're trying to clear out what happened with the port backlog. So another confusing data point that we'll just have to work through. Hopefully this thing is over in a week. The third one is the...
Yeah, I'm sorry, go ahead, Jim. No, go ahead, I'm sorry.
Yeah, last thing is the Boeing strike. Our worst performing big 6 industry sector, 73% of manufacturing is included in 6 industry sectors, is our transportation equipment sector. That is number 2. It's about 15% of manufacturing GDP. And the aerospace piece is about 35% of that. So when you have Boeing, by far the predominant force in aerospace and defense, when you have Boeing coming down, and if they stay down for an extended period of time, they will eventually shut off their supply base. And that will lead to a lot of activity, furloughs, layoffs, lack of revenue, and all that. So you get 3 really going on here outside the global tension stuff. That's a whole different ballgame. Boeing's got to get back to work for themselves and for all of us. This port strike, same thing. Okay, you've got a good point. Make your point. This is a problem when you have a 6-year contract. Nobody could have forecasted the inflation that these poor longshoremen went through in the last 3 years without a real raise. And then you've got the hurricane disruptions that will be a one-timer. And either way, we'll be out of that by probably mid-November.